All right, let's talk about buildings. Welcome to this explainer where we're diving into the fascinating world of IAS 40. I like to call this the property identity crisis because, the rules governing the bricks and mortar around us, they're surprisingly dynamic, and they actually tell a pretty compelling story about a company's underlying business strategy.
So let's kick things off with a pretty fundamental question. When is a building not just a building? Like, how does human intent completely change the identity of a physical structure on a balance sheet? It almost sounds like a philosophical riddle, right? But in the accounting world, the intent behind holding a property literally changes everything about how it's valued and reported.
To figure that out, we're going to follow this quick roadmap. We'll hit defining investment property, tackle the classification challenge, look at initial recognition and measurement, debate the fair value versus cost model, cover transfers and disposals, and finally wrap up with required financial disclosures. Let's get to it.
Okay, Section 1, Defining Investment Property. This is the absolute core of IAS 40, so let's see how the standard lays down the law here.
Here's the crucial point. An investment property is, well, property. Think land, a building, or even just part of a building that is held specifically to earn rentals or for capital appreciation, or maybe both. But the absolute most important differentiator here is independence. An investment property generates cash flows largely independently of the other assets the entity holds. So this is totally different from, say, a corporate headquarters or a manufacturing factory, where the property is really just one gear in a much larger machine generating revenue through production or administration.
What's really cool here is how clearly the standard draws the line between different accounting frameworks. IAS 40 includes things like land held for long-term appreciation, a vacant building you're strictly holding to lease out, and even property that's currently being built for future use as an investment. But look at what it leaves out. It actively excludes owner-occupied property, because that has its own standard, IAS 16. It also excludes property developed just to be sold in the ordinary course of business, like a housing developer building homes to immediately sell. That's just inventory. That falls under IAS 2. But, the real world is messy and lines get blurred, which brings us to Section 2, the classification challenge, and solving those tricky gray areas. Let's compare these two situations because they brilliantly illustrate the concept of ancillary services. Okay, say you own an office building and you provide simple security and basic maintenance to the tenants. IAS 40 views those services as totally insignificant to the whole arrangement. So boom, it keeps its status as an investment property. But over on the right, if you own and manage a hotel, the services you provide to guests, daily room cleaning, dining, the concierge, those are highly significant. Because of that, an owner-managed hotel crosses the boundary. It becomes owner-occupied property under IAS 16, not an investment property. All right, once we've confirmed we actually have an investment property, we gotta officially get it on the books. Section 3, Initial Recognition and Measurement. Time to start the clock.
So there's a distinct three-step path to capitalizing the asset here. First up, you have to prove that probable future economic benefits are actually going to flow to the entity, and that the cost can be measured reliably. Second, you initially measure it at cost. Now, this cost includes the purchase price plus any directly attributable transaction costs, think legal fees, property transfer taxes, that sort of thing. But pay super close attention to step 3. You absolutely must exclude the costs of day-to-day servicing. Those routine repairs and maintenance costs, they do not add to the property's carrying amount. You have to push those directly to profit or loss right as they're incurred.
And now we arrive at the most critical crossroad in IAS 40, Section 4, the fair value versus cost model, the big debate. When you look at your two options side by side, the contrast is honestly stark. If you go with the fair value model, you measure the property at its actual market value at every single reporting date. Any changes in that value, whether it's up or down, go straight into your profit or loss, and you apply absolutely zero depreciation. On the flip side, the cost model relies on historical cost. You apply steady, regular depreciation just like you would for normal equipment, and you basically ignore market value fluctuations. So notice how the fair value model makes your profits bounce around with the reality of the market, while the cost model gives you that slow, steady, predictable depreciation expense. But wait, there is a major catch here. Even if an entity chooses the safer, more stable cost model for its balance sheet, they are still required to measure and disclose the property's fair value in the financial notes. I mean, this is just a fascinating rule. The standard values market pricing so much that you have to figure out the fair value and tell everyone what it is, even if you aren't officially using it as the primary number on your balance sheet. It's basically the ultimate transparency check. Of course, as time passes, business strategies evolve. So let's look at Section 5, Transfers and Disposals, Changing Minds and Hands. There is this amazing detail in paragraph 58 of the standard. It says, in isolation, a change in management's intentions for the use of a property does not provide evidence of a change in use. I love this because it emphasizes that accountants need hard, verifiable evidence. A manager's internal thoughts or some boardroom discussion about eventually selling the building? Yeah, that's not enough to transfer a property out of investment classification. You need physical external proof, like actually starting development with a view to sale or actually signing an operating lease. Action is required here, folks, not just intention. Then, when it's finally time to dispose of the asset, it comes off the books incredibly fast. The very day the property is permanently withdrawn from use or control transfers to a buyer, that triggers immediate derecognition from the statement of financial position. And then, by the end of that reporting period, the difference between your net disposal proceeds and the carrying amount of the asset gets recognized as a final gain or loss hitting your income statement. All right, to wrap up the life cycle of our investment property, let's look at Section 6, Required Financial Disclosures, and how we tell the whole story.
These mandatory disclosures are absolutely vital because they force companies to show their work. You have to publicly declare which measurement model you chose. You got to explain the specific criteria you used when classifying those tricky gray area properties we talked about earlier. You need to break out your rental income alongside your direct operating expenses, like repairs and maintenance. And finally, you have to provide this detailed reconciliation showing exactly how the carrying amount changed from the beginning of the year to the end. It's all about providing investors with complete transparency regarding the asset's true financial performance and the actual judgments management made.
I want to leave you with a bit of a provocative thought here. Imagine two identical companies holding identical buildings, but they choose different models. One picks fair value, the other picks cost. How wildly different could their financial health appear to an investor? One company's profits might soar or plummet based on the local real estate market that year. Meanwhile, the other shows a calm, steady decline in asset value due to depreciation, completely ignoring the booming market outside. It's wild, and it really proves the immense power of accounting choices. I hope this explainer has completely transformed how you look at the buildings around you and the hidden rules that define them. Thanks so much for joining me to explore IAS 40.